Fund Supermart, your online gateway to unit trusts.
Hi, Chris.
Hi, good morning.
Good morning. What is the outlook for emerging markets, especially after Brexit and lingering concerns over China's slowing growth? Is it still a good time to invest in emerging markets equities?
Yes, I would think so for three main reasons. The first reason would be rates will stay lower for longer, just given the developments in Europe, and there would be a lot more allocation towards emerging markets, just given that the whole region has been under-owned for quite some time. Second point would be corporate earnings in emerging markets have been under earnings recession for the last 5 to 6 years. There's been a lot of earnings downgrades. That would mean that the opportunity for earnings to surprise up on the upside will be much more. We are already seeing companies restructuring their balance sheets as well as profit and loss account. The cost side has been reduced over time to reflect the new realities. So when there's actually top line growth, that will actually flow to the bottom line. And thirdly, valuations. And valuations, if you look at the last 20 years since 1995, on a price to book basis, you will see the current price to book is at about 1.4 times versus the last 20 years average at about 1.8 times. So it's a big discount. And on a PE basis, you are seeing again the same kind of discount. On the last 20 years, PEs are trading at 13.8 times PE, but if you actually look at the PEs for current PEs will be closer to 12.6, 12.7 times. This year, next year will be going down to about 12 times. So we are seeing both from a top-down liquidity perspective as well as from a valuation perspective, very supportive in terms of what's happening in emerging markets currently.
In light of this, how have you positioned your portfolio to mitigate uncertainties in the emerging markets?
Well, we've always been very bottom-up in terms of the way we manage money. We focus on companies as opposed to taking a top-down approach. And we believe that the holdings that we have are well positioned to weather through the different cycles. And if you actually look at the different crisis periods, whether it's during the Lehman crisis, whether the Asian financial crisis, whether it's during the tequila crisis in Latin America, the companies that we own have been pretty consistent, and that's where we are focusing on the balance sheets of the companies that we are invested in, and also looking at making sure that the management team and the board is actually aware of all these issues that you're seeing on the macro level. So I think we are generally very comfortable with what we have. We have exposures to the most difficult countries that in the last few years, countries such as Russia. What we are seeing right now in Turkey is the same thing. We have exposure in that country. But we are, again, like what we've said, very, very comfortable with what we have in those countries.
Which are some of the countries or sectors within the emerging markets that the team finds attractive?
Well, it is quite a well-diversified portfolio, but if you look at the individual countries where we have big exposures, will be countries such as India, where we have close to 17% of the fund in. We have big overweight positions in Brazil, which has been not so good performer in the last few years, but this year has been a strong performer, not just in terms of stock market performance, but also from a currency standpoint. Countries such as Mexico, where there is very, very good quality companies and has actually benefited from the proximity to the US markets as well. I think these are some of the big markets that we find very good companies operating in this market, despite all the macro news that or political news that you're seeing out there.
So the Aberdeen Global Emerging Markets Fund has been a standout performer over the past 1 year, relative to its benchmark and several peers. What have been the key contributors to the performance?
The companies that have been beaten down the most are probably the ones that have actually bounced back the hardest. Like I mentioned earlier, Brazil, big overweight position. Some of these companies that have come back quite hard. We've also seen our Mexican holdings, whether it's FEMSA, which is a Coke bottler, whether it's Banorte, which is a banking holding in Mexico. And then also holdings in India, the HDFCs and some of the consumer names in that market has really been the driver in terms of performance this year. But all in all, I think we've been quite cognizant that from a valuation standpoint, Asia and ex-Asia, the ex-Asian markets have come down harder, and that gives us a stronger boost this year, just given from a valuation standpoint and also from a currency standpoint as well.
So why should investors invest into the Aberdeen Global Emerging Markets Fund?
Well, I mentioned earlier, probably in the first question, at the three reasons why you should look at emerging markets, and the first reason is rates will stay longer, commodity prices have been at a low for a long time, is under-owned. Number two is actually corporate earnings, which is on the mend right now, and thirdly, valuations. But on top of that, I think you should look at our fund and consider our fund, the Aberdeen Emerging Markets Fund, because it has been a consistent performer over cycles. We were still exposed to the largest economies from a growth perspective, and the underlying dynamics, whether it's demographics, whether it's penetration of different services, will continue to drive the corporate earnings of companies that are in the fund. So all in all, you are melting the bits on the macro side and corporate earnings, and on the other hand, our investment style are focusing on companies and trying to reduce risk. So from a risk-adjusted basis, I think the fund offers a diversification for I think investors out there from a portfolio perspective.
Thank you.